I think it's unfortunately very high. I think, as we've just heard from the previous commentator, still talking about V-shaped recovery, irrespective of how much the money the Fed's thrown at businesses. If demand doesn't come back after the recovery from coronavirus impact on the global economy, if businesses are out of business, if people are still, hiding away, worried about their future, job security, we will see further damage to the global economy, not running into just the next couple of quarters, but over the next 18 months.
Okay, so Gary, it sounds to me that you don't want to chase any risk rallies here, being that is the possibility or the outlook that you have in mind. I'm also curious as to how you view just the breadth or lack thereof in terms of the risk rally we've seen so far. Many have pointed out that names like Amazon, Apple, Microsoft, Facebook, all of which are reporting this week, have really been concentrated in terms of the concentration for gains has been in a lot of large, successful, high growth stocks even. Does this concern you?
It does concern me because I think people get the wrong impression of the market's environment. If you look at everything excluding the United States, most of the risk markets are down 15 to 25%. And even in the United States, as you say, there's been a very concentrated focus on some very big companies which have given positive gains for the year. Those companies have got strong balance sheets, strong franchises, and very different to the average environment or the average experience we're having through this crisis. So I think markets are actually stumbling here, both bonds in the high yield space and equities over recent trading sessions are starting to stumble, and therefore we could start to see some downside in the coming weeks.
Okay, so we had Bond King Jeff Gunlack talk about how we could retest our mid-March lows. Do you think there's still a case for that? Because the market has recovered, what, more than 30% from the trough, especially the S&P 500 is now just off 17% from the high. Can we reverse and go all the way down, you think? And what will be the trigger for the market to do so?
I think that's the risk. I think, though, in the very near term, clearly people are encouraged that people maybe are getting back to work, that we're starting to see companies reopen, and therefore the economic data will just improve just because it's been so bad. I think the timing of that further dip back down to potentially those lows will be based upon a theory that we are going to see a second round of infections from the coronavirus, or we're going to start to be aware that the V shape doesn't exist. It's more of a long U shape. And that means that we've got many quarters of disappointing economic news, more people out of work, and eventually a lot of companies that will have gone under.